Hi, everyone. Thank you for joining our webinar today on Introduction to Mandatory Loan Sales. Looks like we still got a couple people trickling in, so we'll just wait a few more minutes. Thank you. All right, looks like we've got a good consensus here. Thank you for joining us today on our webinar on Introduction to Mandatory Loan Sales. My name is David Ring. I'm the Marketing Manager here at MCT. Just a couple housekeeping items before we begin. This webinar will be recorded. We'll be sending out the webinar recording after to the audience. If you have any questions during the webinar, feel free to use the chat in the GoToWebinar panel. If we don't get to your questions this morning during the call, we'll be following up with everybody after. So for today's webinar, I'd like to introduce our presenter, Anthony Ianni. He is our Northwest Sales Director at MCT. He's got over 30 years experience in secondary. Anthony, take it away.
All right, David, thank you. And thanks everyone for joining in. I appreciate your time and your interest. And as David said, utilize the chat function, and then we'll take a little bit of time here towards the end to answer any questions as they pop up. And then certainly too, at the end, you'll have contact information for me. And I'm always happy to chat about this, and you can even hit me up on LinkedIn and we can even have conversations there. Whatever's good for you is good for me. But thanks again. So a couple of things, moving to mandatory loan sales, there really are three considerations that you need to keep top of mind as you look at your existing book of business and think about ways to streamline your operation and increase your revenue. Certainly one of those is managing risk with pipeline hedging and moving to mandatory loan sales. There's a part of that too. You'll need to maximize your loan sale profitability. And the final piece of that is the operational changes that are needed to move from a best efforts platform to a mandatory platform. There aren't that many operational changes, and there aren't that many, I'm going to say, severe operational changes that need to be made, but there are a few that you need to consider, and we are going to talk about that. Right now, you're probably, if you're currently locking loans in with an investor, you're probably locking them in on a best efforts basis. There are risks associated with best efforts loans. You are at the mercy of your end investor. As prices are moving up and down, you're kind of locked into that price with your borrower. If they change program guides midstream on you, you may have to adhere to those maybe more stringent underwriting guidelines or loan delivery guidelines. So there are certain things that when you're delivering loans on a mandatory basis, it gives you a lot more, I should say, flexibility in terms of managing that risk and delivering those loans. So historically, the spread between best efforts and mandatory generally is between 25 and 30 basis points. There are a couple of caveats to that. Certainly your investors are going to influence that. Certainly current spreads are going to influence that. How efficient you are on the backside, that's going to affect that as well too. But historically, since my time here at MCT, we've seen lenders be in that 20 to 25 or so basis points lift over best efforts. So anyway, with that, David, maybe you want to flip us over to the next slide. So hedging your pipeline with TBAs and managing risk. TBAs are the associated hedge instrument that we recommend. The easiest way for this call to think about that is you're in essence managing your pipeline of mortgage loans with mortgage loans. The only difference there is you're going to be taking an opposite position. So hedging, in its definition, is managing the interest rate risk of loans in your locked pipeline. It's certainly a strategy that will reduce or transfer that risk from any changes of market interest rates to protecting the value of your baked-in margin into your pipeline. So we use those TBAs to offset the value of the mortgage loans. Certainly, you probably have access or you see trading screens on a daily basis, or you're following along on CNBC, or if you have any of the trading systems that are out there that give you access to seeing TBAs. The difference is to today is right now you're taking those best efforts loans as you're taking the locks in from your borrowers, and you're immediately locking those in with a best efforts investor. That's going to go away. So any of that additional, what I like to call market noise that's associated in your lock desk by taking those locks from the borrowers and then turning those around and going into an investor's website and locking them in individually, a lot of that noise goes away. So there's efficiency number one that you pick up. So those loans, you'll simply take those in from the borrower, and then they're placed into your hedge, and then they're covered with a TBA, and then the associated risk as those loans waterfall their way through your pipeline are covered by those TBAs. The thought process being, or I should say the additional caveat in there is to give consideration to your pull-through. Something that's important is that you have consistent pull-through. Whether your pull-through is 90% today or it's 50% today, you can still hedge your pipeline. The key thing to think about is consistency of pull-through. So if you're at 90% today, 50% next month, 40% the following month, and then back up to 90 in the fourth month, that can create some inefficiencies in your pipeline and become kind of expensive for you when you hedge. But if you're consistent and you can manage that piece of it along with MCT, you should see some success there on the hedge side. So again, you're no longer locking that loan on an individual basis with your best efforts investor. So the TBA is entered into once the lock comes in and the loan enters into the hedge. And then as it waterfalls its way towards closing, your pull-through, the chances of that loan actually closing are going to increase, right? So as that pull-through percentage increases, we will add a little more TBA coverage until you get to closing. And then once you're at closing, you're almost at 100% completely hedged. And that's going to give you surety of purchase and surety of managing and protecting your in-house margin. So another key thing to think about on the TBA piece, and I mentioned this a few minutes ago, is the fact that your TBA position and your loan position are going to move in opposite directions. So as the value of your loan pipeline is increasing, so if we're in a market rally and interest rates are declining and prices are getting better, the value of your TBA position is decreasing, and vice versa. So you may be talking to people today, or you may be watching the screens and you're kind of seeing that today. So the key thing to remember is always being at interest rate neutral. And that's one of the philosophies that MCT has always followed since inception. What that does is it makes you indifferent to what happens economically speaking and how it affects rates or anything else, by keeping you as close to zero hedged as possible. Will usually ensure that we can protect your margin that you have baked in there. So now once you've completed that loan's closed. In the case of a refinance, it comes out of rescission. Then we're ready to make those mandatory commitments. But let's kind of talk a little bit about some efficiencies here. We talked a couple of minutes ago about all the multiple changes that you do, like when the loan locks come in. So it's going to decrease your per loan operational expense. What it does is while you'll still need to keep up on those post lock adjustments, it's very, very important to making sure that your reporting is nice and neat and tidy. Your lock desk personnel. Go ahead.
Hey, just got a quick question here.
Sure.
Can you talk a little bit more about defining what a TBA security is?
Yeah, definitely. So the TBA stand for TBA, or to be announced. They are in essence the forward contract on mortgage-backed securities. So if you look at the trading screens today, TBAs trade in 3-month increments. So today we're looking at March, April, and May. Soon here we're coming up to settlement, so we'll start to look at April, May, and June. The loans that are being originated today and maybe even last month and in the future, ultimately these loans wind up in these TBAs and become mortgage-backed securities. So TBAs facilitate the forward trading of mortgage-backed securities issued by the GSEs. So Fannie and Freddie do them, as well as Ginnie Mae as well. So TBAs will allow a mortgage banker to hedge their origination pipeline, and it makes it easier because, as I say all the time, you're hedging mortgages with mortgages. The other great thing about utilizing TBAs is behind the U.S. Treasury market, TBAs are the second, mortgage-backed securities are the second largest traded security out there. So it makes it easy to enter into TBAs. It makes it easy to exit out of them. Many of the dealers, whether they're the primary, the larger dealers on Wall Street, or they are the more nimble and a little easier to deal with regional broker dealers, many people deal with TBAs. And like I said, with technology today, I mean, with our, with MCT's agile technology, we have the ability to trade these TBAs through the MCT Live system. So we've taken a fairly fast and efficient system and made it even faster and way more efficient, and in some instances maybe even a little more price competitive for people. So hopefully that answers that. Go ahead.
One more question for you on this, Anthony.
Please.
Can you give loans? Can you give loans to satisfy your TBA position, or do you have to enter into an offsetting trade?
So if I understand that correctly, what I think you're asking is can you fill those TBA positions? And the answer to that is, it's a little long, but the answer to that is yes, provided you have prior approval with either Fannie or Freddie or Ginnie. So most people today, when they deliver loans to Fannie and Freddie, there are certainly a few lenders out there that are creating mortgage-backed securities and doing securitizations. When you're approved with Ginnie Mae, you they do not have they don't have cash. So you're going to create a security and then ultimately deliver into that and sell that to an appropriate dealer or sell it to someone else. So the short answer to that is yes, provided you have a couple of things, provided you have the appropriate approval with Fannie or Freddie, and that you're using the expertise of MCT to walk you through that process, and also to have access to some of our technology that will make that process a little easier in slotting those loans and calculating what's the appropriate security that those particular loans can go into. I mean, it's one of the many things that we specialize in here, if you weren't aware. So as I said,
Anthony.
As I said, TBAs trade forward 3 months in advance. There are monthly cash settlements based on a net position. So it depends on whether or not the TBAs are in the money. So the person that's holding those, they'll be owed money, or from the dealer, or perhaps the opposite position. We saw some of those pair outs last year where the lenders owed the individual dealers cash, but they do trade. So TBAs trade. Sorry about that. TBAs will settle throughout the month. So conventional 30-year product is what we call Class A. They settle usually around the 10th through the 12th or so of each month. A couple of days after those are the shorter term TBAs for Fannie and Freddie. So the 15-year and smaller, they will settle. Those are considered Class B. And then usually around the 20th of each month, Class C, which are the Ginnie Mae securities, those will settle. So in the case of, the work behind it is you simply, all those positions are paired out of. There'll either be money being wired to the broker dealer, or money will be coming into the individual lender from the broker dealer. Those funds are verified. Your MCT trader is going to work with you to make sure that you have the appropriate wiring instructions and that the funds are wired out on the actual settlement date. So that's one of the many things that we support you for. So, and that's it on the TBA side. But anyway, maybe David, if you want to flip us to the next screen, that would be awesome.
There we go.
All right. Thank you. So a couple of things. So now that we've kind of learned a little bit at high level on the TBA side. So why do I want to do this? Your pickup, as we talked about earlier in this conversation, your pickup is going to be over best efforts. And generally, depending on the market, depending on your investors, which MCT will work with you on, generally your pickup is going to be somewhere in that 20 to 30 basis point spread. Something to think about, though, when you're giving consideration to moving to a hedging platform and delivering loans on a mandatory basis. Start to think like your investors. You become the inner investor by setting your own lock extensions, your own rate renegotiation policies, and pretty much how you manage your pipeline can be set internally. We can work with you on that. I can work with you on that to kind of set those parameters. But it's very important to think that way. So think about it. If the market is selling off, your investors are sending you out reprices throughout the trading day, but you're beholden to them. You have to wait for them to reprice. And then you have to kind of shut your operation down so you can receive all the rate sheets in from your investors and reprice appropriately. But as a pipeline hedger, you can do that a lot quicker. You have access to your trading screens. You have access to a trading staff at MCT. The market sells off by 1/4 of a point. You can simply go into your product and pricing engine, increase your margin as appropriate, and move on with your day. Same thing with like extensions and rate renegotiations. Right now, you're beholden to your individual investors. They're going to, in their extension policies and their rate renegotiation policies, they're going to pass through the cost of the hedge to you. But as someone who's hedging their pipeline and delivering loans on a mandatory basis, you get to set those extensions. Certainly, you have to be mindful of those. I don't think it's a best practice, and I never did it when I was managing the pipe. it's not a best practice to be giving freebies out to your loan officers and letting them extend loans at will for no cost. There is a cost associated there, but I can guarantee you it's nowhere near as much as your investors are presently charging you that. And the same with rate renegotiations. By hedging your pipeline, you always know how much your gain is on an individual loan. So then if the borrower calls you and is beating down your door for a lower rate because interest rates have declined quite a bit, then you can start to work with your trader here at MCT to kind of calculate what lowering that interest rate would be and what that would do to your net profitability. And then as a business owner, you have the ability to make an informed decision. So then you can say, okay, I was making $10,000 on this loan, and if I drop the rate by a quarter, I'm only going to be making $5, but it's a brand new source of business for my company. We're trying to keep these guys happy. These guys are moving to the area. So there's a lot of variables to consider, and hedging will allow you to make a much more informed decision. And then the final piece of that is mandatory deliveries allow for a broader range of execution options. Right now, if you're delivering loans on a best efforts basis, you have 30-day locks, you have 45-day locks, you have 60-day locks. But with mandatory deliveries, you can have those as short as 5 days. So it allows you to shorten your delivery period, but also too it opens up a number of different ways to deliver those loans. The method that most folks are using today are through bid tapes. So it's bid tapes are sent out to individual investors, and then you're receiving individual loan prices back on those bid tapes. Back when I was doing it, we were a lot less efficient than MCT is these days. So back then we would send out, a $5 million bulk tape, and we would receive an all or nothing price on that. So we had to kind of back into what we wanted to do. But with the advent of the MCT Live system and the technology that we've developed to help folks make this transition from best efforts to mandatory, you can make a very, very informed decision on where these loans are going. So the neat thing is, 3 loans may go to investor A, 2 loans may go to investor B, 3 loans may go to investor C, and that makes things a lot easier. So definitely something that will aid you in maximizing your profitability. I don't want to get too deep into the second bullet point about pull-through rate, but one of the things that's really important, as I said before, is making sure that your pull-through is consistent. And we have, things that we can talk to you about offline to kind of show you, share some best practices on some things that you can do on the pull-through side. Yeah, I'll admit to you, sometimes you have to be a little tough with the mortgage loan officers. I know it's easy for me to say sitting in this seat versus you guys that are owners of businesses and that are managing production staff. But I can promise you that by adhering to some of our methodologies and suggestions and giving strong consideration to that, you will find that your success rate and that your profitability will be enhanced by doing that. So now we talked a couple of minutes ago about, TBAs are adding coverage little by little as the loans are waterfalling their way to closing. And now it's time to close those loans. And maybe David, so there are, a couple of things to think about before we actually talk about the individual executions there. But what we like to do is be conservative in our hedging. So always keeping you at interest rate neutral, which I think is a very key component and one of the reasons why we're so successful at what we do, but being very, very, very aggressive on the loan sales side of it. So we look at every execution option available. So what we'll do is we will take your investors, and if they are accepting bulk bids and single loan mandatory, and maybe perhaps they are accepting assignments of trade and other types of execution options, including best efforts, we will consider all of that. And then the other key component in there is nothing's free, right? So when you deliver a loan to an investor, you have to pay them a fee to have that loan purchased. So whatever that loan funding fee, if it's $250 or $300 or $400, whatever that number is, that's part of execution. That's included in your best ex. So when you receive a best execution from MCT and are ready to deliver those loans to an individual or commit those loans to an individual investor, you can be assured that the price that you're looking at is the real price. It includes any associated fees or any type of extra delivery fees like that. So some other considerations to maximize profitability. We kind of talked about that on the lock desk side and being more efficient with your extensions. I touched on it briefly, but electronic trading of TBAs, there's always the possibility that you could pick up a little more from that, depending on what the market's doing and the appetite of the particular dealer. Assigning trades can accelerate the cash experience for lenders. So in other words, if you're pairing out of a trade that settles in May today, but you assign that same trade to an investor, and let's say it's in the money, the dealer is going to owe you money, you will receive that cash sooner rather than later. So there are some advantages there that you'll pick up. And there are carry opportunities. If you're a financial institution on the line, or if you're a credit union, you may have, because your cost of funds are priced differently than the independent mortgage bankers who rely on warehouse lines of credit, there may be opportunities there for you to earn a little bit of spread based on where your current cost of funds is priced at versus where you have that loan originated at. So again, that's one of the reasons why you want to employ someone like MCT to walk you through that, to do the math for you, to have those steady conversations where our traders are very experienced. They're in the market. They've been there a long time. They understand how this works. And these good folks will make those execution suggestions. And people kind of laugh at me a little bit, but this is very true. A basis point over here and a basis point over there always go right to your bottom line, and the bottom line is my favorite place. So anyway, and
hey,
go ahead. Yeah.
Can you talk a little bit more about AOTs?
Yeah, definitely. So basically what you're doing is when you're assigning a trade. So during the normal settlement month, you're entering into your traders entering into TBAs, and then those TBAs will cover your mortgage pipeline. But based on a variety of factors, maybe it makes sense to deliver. You can free up a little bit of cash, or at least earn a little bit of cash, and you can deliver those loans, or you can, in essence, you can assign that trade from the dealer where you originally executed the trade at, and assign that loan to one of the aggregators that are presently buying on an assignment of trade basis. So what we'll do is you can deliver loans into that assignment of trade. So you have the original trade that it was struck at. So let's say it was struck at par. Let's say now the price on, the market has rallied, and the price on that TBA is no longer par. It's at 101. So it's 1 point out of the money. That 1 point out of the money is going to be adjusted into the original trade price. But what it does is it allows you to receive the cash on the loan sale a lot faster. But also too, it allows you to eliminate the bid-ask spread. And what I mean by the bid-ask spread is if you look at the screens, you'll see there's two prices. Generally on conventional loans, at least the last time I looked, the spread on that is about 1/32 or 0.03125. And then on Ginnie Mae's, it's a little wider. So you can eliminate that bid ask. So the fee that's charged from buying or selling that TBA. So there's some additional funds that you can save right there, especially on the Ginnie Mae's, plus experiencing the cash a lot faster, plus allowing you to deliver into some of those securities. And that kind of can kind of help add some efficiencies. We have a lot of lenders that like the assignments. I mean, it's not done every month. I will caution you on that. It's certainly something that our clients and our traders will work their way through to make sure that the math works for the lender. But our system is set up that when we do the best X, our system will scan through and look to see which of those loans, those closed loans, are eligible for AOTs and what that associated revenue gain could be by doing that.
Awesome. Thanks, Anthony.
It's a lot better today. MCT has done a phenomenal job of streamlining that process. I can promise you a long time ago when I was doing it, it was nowhere near this efficient. And then the final piece of that is there's basically the Rosetta Stone of documents that you have to execute when you enter into an assignment of trade, because it's a tri-party agreement. What we've done is we've automated that process. So any of that brain damage that's associated with filling out all those forms, once you say to your trader, yep, this is something we're going to do, it's as easy as they simply press a button. All the appropriate fields are filled out, and those are sent out to all the associated parties. So again, it gives you better control and has made the whole process cleaner and a lot more efficient. Anyway, so David, maybe we'll go to slide number 5. Maximizing profitability continued.
Yes, sir. You're on it.
Yep, optimizing your investor set. The average client these days has somewhere in the neighborhood of 10 to 15 investors that they manage. That's really important because the goal is to always make sure that you have the best price out there. It's one of the reasons why you pay us, is to ensure that. So one of the things that that we're always looking at is how can we better optimize your investor set? And as a business owner, you should always be thinking about that too. So by making sure that you have access to all of these individual investors who are constantly paying up for specific product is really key. The more buyers you have competing for your loans, the more likely you're going to receive a better price for your loans. It's not like a bunch of years back where you would not be rewarded for that. Today, it is okay if you're selling a small smattering of loans to a larger population of lenders versus the way we had to do it a long time ago. So I think that's really key. So your MCT trader and those of us on the business development side here at MCT, we're always staying abreast of who's doing what execution looks like, what we're hearing on the backside. That's very important. Are folks easy to deal with? Are they not easy to deal with? You guys, that if you're presently delivering loans on a best efforts basis, you're doing some of that right now. So, but again, it is important to give those considerations. So, anyway, David, if you want to kick us to the sixth slide.
Yep, you're on it.
Thank you. So again, evaluating the pipeline and market conditions. Also, just keeping abreast of what's happening market-wise is important. If you're considering making the move from best efforts to mandatory, we have a lot of conversations. You'll have that with your trading staff. But one of the things that we do is we'll make recommendations throughout the trading week and month and quarter and year about what we're hearing and seeing. And in the case of extreme volatility, we did this last week, we send out what we call market flashes. Those are really, really important, where we make recommendations on how you should be managing your pipeline. One of the main things is if the market's volatile, it's okay to add margin to your price. Because again, the thing that you always want to do is you want to protect the house. So I repeat myself here, but think about acting like the investors act. They would do the exact same thing. You probably see that in your rate sheets too, during particularly volatile markets. So I think that's really key. So looking at trends, our reports are really vast. So we have reports down to the loan officer level. So are you seeing consistent high pull through from loan officer A, but consistent really horrible pull through from loan officer B? And then that gives you, as a business owner and as a pipeline manager, that gives you the opportunity to approach that person or approach their branch manager and have a conversation with them. Because again, hedging costs about a half to a basis point a day, give or take the market on that particular day. If you have loans, if you have an inefficient loan officer or branch where they're simply just taking the lock from the borrower and leaving it in the hedge, and then it expires 30 days later and it never closes, you pay hedge cost on that. So by evaluating and staying up on top of your originator's pipeline will allow you to continue to monitor, obviously monitor performance, but also, it will affect your profitability. So I think, by using the reports, we even have something out there called status stagnation, which I think is really key. If you linked in with me, you'll probably see me talk about status stagnation, but that's a really important report, in my opinion. Loans need to efficiently move through your pipeline. And as we always say here, efficiency is rewarded. And it's very key to, if you can shave off 2 days in your processing time and a day in underwriting and a day in closing, that additional savings there saves you on hedge cost. It allows you to get those loans out the door faster. It allows you to perhaps maybe take advantage of a little better pricing that may be available because you are more efficient. But also too, it allows us to take maybe advantage of taking that original TBA coverage and maybe going through a process which we call recyclings. And maybe we can use a piece of that again on some newer, younger production that comes through. So again, hedging rewards efficiency, absolutely, positively. And I think reducing your cycle times will ultimately reduce costs. And I think, one of the things that we do really well here is regular reporting and performance calls. And we have a business unit called Business Intelligence who provides a number of metrics, and we can compare you versus your peers in the MCT ecosystem to kind of show you what your times look like versus theirs, and a number of other metrics that we can, we have the ability to report on. So certainly it's a great have here at MCT. Anyway, so on the profitability side, so you're probably wondering, like, I want to make these changes. I want to move from best efforts. I want to become more efficient. I want to make more money. What's that going to do to my operational changes? The good news about it is it's not really going to change a lot. And one of the things that I always recommend, at least initially when you're starting, is with your current lock process with your loan officers and branches, and let's say you're giving them access to current rate sheets in your product and pricing engine, my suggestion is always to kind of leave that be, at least initially. At some point, once you start to get comfortable each day with hedging your pipeline, maybe it makes sense to create an in-house rate sheet where you're trying to direct those loans to that product versus some other pricing out there. But my opinion is if it's working, I would probably at least leave it where it is. But on the lock desk side, you do need to agree to a process with MCT to identify those loans to hedge, and that's simply what we call the hedge flag. So it's just simply right now, if you're on Encompass, for example, there is a in one of the screens, it simply says hedge yes or no. Right now, you're probably bypassing it. You're just ignoring it, so it's not being reported on. But what you will have to do in your lock desk process is you will have to click on that hedge yes. That's going to be really important. The other piece of that is, though, any of the post-lock adjustments that have the potential to change your base pricing. So as FICO and LTVs are increasing or decreasing, as loan amounts are increasing or decreasing, borrowers are being added, borrowers are being subtracted. You still want to stay on top of those post-lock adjustments. That's really key. So that process will not change, but you think about the efficiencies that you've gained. You're no longer locking in on 15 individual websites, and you're no longer going out to 15 individual investor websites and making those post-lock adjustments. So your lock desk staff is simply at their desk, making those appropriate changes and passing them through to your LOS, and which ultimately gets pushed into the MCT Live system. So pretty easy there. From an underwriting perspective, you're not really underwriting to a single investor. You're identifying which investors it can go to. The easiest way for me to explain that is can go, can't go. I've always found underwriters are sharp, they're smart, they have this uncanny ability to take a peek at a file and say, yep, it's eligible to go here, here, and here, but it can't go there and there. I don't know how they do it, but they do it. That's going to continue. So we'll work with you to identify that process, and it may be as simple as the underwriter goes into your LOS and simply puts, investor A, B, and C, yes, and investor D and E, no. What that does is that allows us, that information is pushed to us. We scrub that through on our end to make sure that it's not sent to one of those no investors at the time of best execution and committing those loans. So that's really key. What we find is lenders will come back to us after they've been hedging for 60, 90, 120 days and say, oh my God, my underwriters are so happy about this change. It's made life so much easier for them. So it really is not a big change. Your warehouse lender approvals, if you're an independent, you do need to talk to your warehouse banks to tell them that you're going to be moving to a mandatory platform. They right now, they may recommend that you prepare your closing docs in the name of you, so in the name of the lender, but they may have some other changes to their delivery of the legal docs that they are going to want to see. They may also want you to forward a report out to them on a regular basis, whether that's weekly or monthly, and that report's called the mark-to-market. Basically shows the value of each of the individual loans that are presently in your hedge. It's pretty easy. It's really a conversation and maybe just a minor process change there. Broker-dealer approvals, that's really important. So making sure that you have liquidity is really key. So generally the dealers like to see anywhere from $3 million in net worth on up. And that's the investor approvals for mandatory. They're probably going to be in the same range there as well too. The broker dealers are very important in that they are the folks that will aid in conducting the TBA trades. So they're going to have a conversation with you about your net worth, about your liquidity. It's a fairly easy process, but something to keep in mind is having multiple sets of broker dealers. So the good thing about that is the more that you can become approved with, the better it is from a liquidity standpoint. So, and also too, it can reduce some potential for any calls on margin if the market is particularly volatile. So we are going to work with you on that. Actually, all of these things here, all these bullets that are in front of you, MCT is going to work with you on that. We do quite a bit of work on that up front, just to kind of walk you through the process and make sure that you're comfortable with it, and we make those appropriate introductions. In additional investor relationships, as we've said this a few slides back, maximizing your investors is really key. So, we may make some recommendations that, you may take, or you have the ability to not accept those. But we may make some recommendations to kind of bolster your existing stable of investors. And something else too that we created as a result of last year's post shutdown situation was what we call our BAM marketplace. So we do have the ability to help aid in maybe some less liquid product. We have the ability to send those loans out for bid and help you out with product that maybe is a little less liquid versus some of the other product that you have out there. So certainly something that we can help you with there. From a secondary standpoint, really what we're going to work with you on is ensuring that we're going to be receiving live pipeline data from you throughout the trading day, depending on the it can, there's always a conversation up front to talk to you about data integration and how can we receive this. We're very efficient with data. Our guys in our client success group and our traders are excellent at taking data and slicing and dicing it and thinking outside of the box. So it's usually, we're not really afraid of processes out there. So we can always come up with a solution to make sure that we're receiving accurate pipeline data. And we do a lot of scrubbing too as well. So we always want to make sure that what we're receiving is accurate, et cetera. On the accounting side, on the finance side, there are some new cash flows. We talked about TBA settlements would happen each month with the broker dealers, but then there's also the implementation of fair value accounting. We support that. It's actually so important. It's part of the onboarding process. So we will jump on a call with your finance people to have a conversation with them, to talk to them about some of these additional cash flows. We will support that in our nightly reports. Maybe it doesn't make sense on a daily basis, but at the end of each month, on the last day of the trading day, those entries on both sides of the financial ledger are going to become very important. So we support that. We have support implementation. Back, I think it was with Richie May back in 2014, we authored a white paper with them on this very subject. So it's very near and dear to us. And if it's, so do not fear it. It's something that we support. And, even on the accounting side, if you needed to have a conversation with one of the accounting firms, we can certainly make that introduction and make sure that you're comfortable with that accounting piece. So really, it's not a lot. There are some very minor pieces, and I will tell you this: there are people that have been hedging with MCT for over 10 years. We even have a couple of guys who have been with us for even longer. And what they tell you is once they made the switch and they picked up the efficiencies, they'll never go back. So even in volatile markets, even in volatile markets, that back office running around and that back office noise, as I like to refer to it, while it still may be there a little bit, it's nowhere near as great as that onslaught of loans that are, your loan officers are opening up their briefcases, as we used to say, trying to get those loans locked in because the market's going to reprice. So anyway, the operational changes are pretty simple. So David, if you want to go to the next one there, that would be awesome.
Yes, sir.
Yep, thank you. So it's mandatory right for my firm. You need to have a centralized lock desk. Having loans, if you're having your loan officers locking individual loans in, and they are not, and they're locking them in and then they're yanking them and sending them to another investor because the market got better, that's not a good strategy. So if you really want this to work, centralizing your lock desk and having an individual do that for you is very key. So we talked about this in the previous slide: reliable and continuously updated pipeline data. We're going to work really hard and do a lot of the heavy lifting for you in advance to make sure that the data we're receiving is clean and that it makes sense and that it's regular. So we're going to, so you're going to want to think about that. So if you have some data issues, we'll definitely want to identify those sooner rather than later to have a conversation about that. You definitely want to be delegated. So there are many folks nowadays that are making the move or considering the move from non-delegated to delegated, but being delegated makes your life a lot easier. It's going to make your underwriter's life a lot easier too. So What you don't want is non-delegated lenders. You're at the mercy of your investors' underwriting turn times, and that's not a good thing. So certainly you'll want to make sure that your underwriting's in-house. We talked about these mandatory approvals from investors, your warehouse providers, and the broker-dealers. We talked about your net worth. I like to see it. I'm not saying it's it can't be done, but it will be harder. But I think, if your net worth is somewhere in the neighborhood of about $3 million on up, this is something that you should strongly consider, just because of the additional gains and efficiencies in revenue. And then finally here, 10 to 12 million a month in agency eligible saleable production. That's really key. So agency eligible, anything that can go to Fannie Freddie, and certainly FHA VAs, USDAs can be hedged. Something that I always like to throw in is it's very important that you have at least 2 investors for all of your product. So you can hedge USDAs, but if you only have one investor today, that's not that one investor that's purchasing them, maybe it's not a good idea to hedge those USDAs. If you're offering Govy loans at 620 FICO, maybe, and you only have one investor for that, maybe it's not a good idea to throw those loans into the hedge. But we're going to talk to you about that, and we'll evaluate it and we'll make suggestions. So it's not, it's not an absolute, but certainly something that we'll want to have a conversation on. And then liquidity. Liquidity goes on along with your net worth, and it also goes along with your broker dealers as well too. So having the ability to have multiple dealers and have multiple lines of credit out there with your individual dealers is going to be very key. The cool thing about those lines of credit is after you're approved, that's pretty much it. There's no non-use fee or anything like that when you receive a dealer line. So certainly they want you to use them, and it's encouraged that you use them because those dealer relationships are important. But certainly once you have them, those are pretty easy to maintain. And then David, we'll do the final one here, and maybe we'll take a couple of questions. So, MCT provides solutions for lenders of every size. So whether you're hedging 10 or currently originating 10 to 12 million a month on up to $1 billion. And believe it or not, there are lenders that do a lot of loans every month that are still doing it on a best efforts basis. We have a solution for you. Absolutely. So our hedge advisory, we structure our hedge deals the way you would like those structured. So we don't have a one size fit all box. We listen to our clients. We listen to how they're presently doing things. And throughout that process, we're transparent. We share information. We don't hide information. We're not, the Wizard of Oz hiding behind the curtain. We like that transparent piece and transparency piece, and we love the training piece. From my perspective, I'll give you a personal thing here is when someone makes the move from best efforts to mandatory, and everyone, it's something new, so you're always kind of thinking about it, and maybe you're a little afraid or whatever. The neat thing for me and the pleasing thing for me is 6 months later, you talk to the secondary marketing manager or the capital markets person, and they're totally different. They're confident. They're talking about, TBAs and doing this with the trades. And, oh, by the way, the trader and I had this conversation. So they learn all this stuff from us. And it's very pleasing for me from my seat here on the business development side. So, but we have solutions that can help you grow. So if you decide to get your agency approvals and you want to retain the servicing, we have a solution with our MSR services group. We have Lock Central. We just talked about having a centralized lock desk. We have the maybe even the world's largest outsourced lock desk services. So we presently have a large amount of hedge clients that are utilizing those services. We can do initial locks all the way to full service, and that helps lenders when they make the move from best efforts to mandatory, maybe utilizing MCT services to kind of help get you to that hedging piece may be something, beneficial for you. Product and pricing, we can certainly do rate sheets. We can have conversations with you on fair value accounting if you're a financial institution and maybe you're you're looking at your best efforts pipeline, we can certainly help you there. And I mentioned previously our business intelligence group. So we have a proprietary system that we've built that's based on information that we have from our large amount of clients. We can spit out investor report cards. So just like investors are sending you a report card on a monthly basis, you'll have the ability to do that back. So we can kind of talk to them about how they're performing. So definitely a lot of individual things that we can provide on the business intelligence side. So, and with that, David, maybe we'll open it up to questions. How's that?
Awesome. Thank you so much, Anthony.
Yeah.
Yeah, that was great. Do you have one question I wanted to follow up with, and this might be a good one to follow up with after the webinar, but regarding TBA commitments, if you do fill your TBA commitment with actual loans, what is the pickup compared to closing your TBA with an offsetting position and selling to an investor?
That's a good question. And to be honest with you, I'll have to follow up with you after that because I'll have to talk to the desk.
Sounds great.
Yep. It's a great question though. Thank you.
Yeah. So it looks like we were able to answer all of the questions throughout the webinar.
Okay.
Yeah. Appreciate everyone's time today, and we'll be sending out the recording after the webinar. And Anthony, again, thank you so much for your time on going through Introduction to Mandatory Loan Sales.
No, thank you. So if I can be of service to anyone, or if anyone has any questions, as I said, email, phone, text, LinkedIn, whatever's convenient is, I love this stuff, and I love talking about it, and would love to see all of you guys as clients as well too. So thank you very much. Enjoy your day.
Thanks, everyone.
Awesome. Take care.